The question comes up constantly in wealth planning conversations. Should I set up a holding company or a trust? And the answer almost every time is the same. That's the wrong question. They don't compete. They serve completely different purposes, and when used together, they create one of the most powerful wealth protection and transfer structures available. Let's start at the beginning and build this up properly. What a holding company actually is. A holding company, sometimes called a holdco, is a corporation or LLC that exists not to sell products or hire staff, but to own and control other businesses and assets. It sits above the operating companies, holding equity stakes in them without getting involved in the daily work of running them. You've seen this structure your whole life without necessarily realizing it. Alphabet Inc. is the holding company for Google, Waymo, and a dozen other ventures. Berkshire Hathaway is the holding company Warren Buffett uses to own stakes in GEICO, Dairy Queen, and hundreds of other businesses. The holding company manages the overall structure. The operating companies, the opcos, do the actual work. The primary reason to use a holding company is risk isolation. If one of the operating businesses gets sued, faces a judgment, or goes bankrupt, the assets held in the holding company and in the other subsidiaries are generally protected. Each business is a separate legal entity. A catastrophe in one doesn't automatically become a catastrophe in all of them. There are also tax advantages. In the United States, a parent holding company that owns 80% or more of a subsidiary may be able to avoid paying taxes on dividends. This allows income to move through the corporate structure in a more tax-efficient way, consolidating losses from one entity against gains from another. And holding companies provide centralized control. The owner holds shares in the holdco, and through those shares, they exercise control over every business underneath it. One structure, multiple businesses, clean lines of authority, what a trust actually is. A trust operates on completely different logic. A trust is a legal arrangement where a trustee holds and manages assets on behalf of beneficiaries according to terms the grantor established when the trust was created. The key distinction is how ownership works. In a holding company, the owner holds shares, direct ownership. In a trust, the trustee holds legal title, but the beneficiaries hold the equitable title. Ownership and benefit are separated. That separation is where most of the trust power comes from. Trusts are primarily designed for three things: estate planning, wealth transfer, and asset protection. A revocable trust, the most common type, avoids probate, keeps the estate private, and transfers assets directly to beneficiaries. An irrevocable trust gives up control permanently, but in exchange, assets are generally removed from the taxable estate. That's the trade, control for protection. And because trusts are private documents, they offer a level of confidentiality that a holding company typically can't match. How they actually compare. Let's put these side by side on the dimensions that matter most. Asset protection. A holding company limits liability to the assets within each subsidiary. An irrevocable trust can shield assets from personal creditors entirely. Taxes. Holding companies are often used to defer taxes. Trusts are typically used for income splitting to beneficiaries in lower tax brackets. One critical tax note for 2026. Trust income hits the top federal rate of 37% at just $15,200 in taxable income. Distribution is now a priority. Succession and longevity. A holding company can exist in perpetuity. Most trusts have a termination date, unless they're structured as dynasty trusts. Privacy. Both offer it, but trusts with no required public filings in most states generally offer a stronger privacy profile. The 2026 regulatory landscape, what changed? The landscape shifted significantly regarding corporate transparency. In early 2025, FinCEN removed the requirement for U.S. companies to report beneficial ownership information. All domestic entities are now exempt. What hasn't changed is the estate tax landscape. The One Big Beautiful Bill Act set the federal exemption at $15 million per individual. A critical note, Revenue Ruling 2023-2 is still in effect. Assets in irrevocable trust generally do not receive a step-up in basis at death. Strategy is key. The pro strategy, trust over holdco. This is where the two structures work together rather than competing. The most sophisticated approach looks like this. The trust sits at the top. The trust owns the holding company. The holding company owns the operating businesses. The holdco provides operational separation and risk isolation. The trust protects your interest from personal lawsuits and simplifies estate transfer. A business owner passes away. Without this structure, probate could take years. With it, the trust continues operating seamlessly. The transition is invisible. When to use each one: a holding company for managing businesses and isolating risk, a trust for estate planning, privacy, and asset protection. And when you have both, trust at the top, holding company in the middle, operating businesses at the bottom, it's about long-term structural optimization. Practical takeaways. First, operating businesses should be set up where they actually operate. State law governs how businesses work. Second, an unfunded trust protects nothing. Every interest in the holding company must be formally retitled. The document alone is not enough. Third, prioritize distributing income to beneficiaries due to rate compression. Fourth, understand the costs. Legal and accounting fees are an investment in protection. The bottom line is simple. A holding company controls businesses. A trust protects and transfers wealth. Together, they create a structure that just works.